learners, and welcome again to our session today. So it's a continuation of what we were doing earlier on. So in that case, we had talked of part 1 of the question where the examiner wanted us to prepare our profits. Part 2 of this question, you'll find that the examiner wanted us to do the reconciliation. Reconciliation of what? Reconciliation of our budget profit and our actual profit. So in this case, we are going to write them here. Budgeted profit. We had a figure of how much? 1 million, right? We have a figure of 1 million in regard to our budgeted profit. Our actual profit here, our actual profit, we've determined it to be 1,526,100, right? So it's upon us to do the reconciliation of the two profits. And in doing this reconciliation, that is where we are required to do what? That is where we are required to prepare our variances. That's where we are required to prepare our variances. So in that case, allow me to erase here, because you have this data already, So you'll find that, my good students, variance analysis is one of the simplest concepts that you'll ever meet in MA. So long as you're not cramming the formulas, it will be very, very simple for you. So as we mentioned, we noted some of the variances that we need to compute, like we do have the costs, material. So I need to calculate the material cost variance. Because here I'm having what? The direct materials, direct labor, variable production overheads. So in that case, we need to calculate what? Material cost variance. So number one variance that we need to calculate is what? Material cost variance. The question is, do you still remember how we normally determine material cost variance? We normally talk of our standard total costs, which our standard total costs normally determine it by taking our standard quantity of the material, we multiply by our standard price of the material, we less our actual quantity of the material, we multiply by our actual price of the material. And remember, we said that you'll never be given SQ. At no any given point will you ever be given what? Your standard quantity. And to determine our standard quantity, if you can recall, my good students, we normally talk of what? We normally talk of our standard quantity of the material. Standard quantity of the material, of course, let me have it. Standard quantity of the material per unit times our actual units. This will give us our standard quantity. And standard quantity, remember we said that these are the quantity that should have been used for the actual units produced. So therefore, to determine our standard quantity, I need to ask myself, how many kgs are we budgeted to use to produce 1 unit? Come to our question here. How many kgs are we budgeted to use to produce 1 unit? And how will you get that? Look at our direct materials. You can see I'm having 6 kgs at how much? At 40 shillings. 6 kgs at 40. So therefore, it means that I was using 6 kgs. I budgeted to use 6 kgs in producing what? In producing 1 unit of our material. So therefore, I should be talking of 6 kgs here times the actual units that you are producing. You see that you had how much? 18,500. You had 18,500. So confidently, we can determine our standard quantity by taking 6 times 18,500. That should give us 111,000 kgs. So that should be our standard quantity. That should be our standard quantity. That should be our standard quantity. So therefore, to determine that, it should be having 111,000 kgs times what? Times our standard price. How much had I budgeted to purchase each unit? How much had I budgeted to purchase each kg? Looking at our question here, I had budgeted to purchase each kg with how much? 40 shillings, right? I had budgeted to purchase each kg with 40 shillings. 6 kgs at 40 shillings per kg. So standard price is 40. So in this case, I should be talking of how much? I should be talking of 40. That will give us that minus the actual quantity times the actual price. Ideally, this is the total cost of the materials. This is the total cost of the materials. Total cost of the materials. The actual cost that I've spent in relation to our materials. And in that case, you can see in our question here, the actual cost that I was given for materials, the actual cost that I was given for materials, I was given a figure of how much? I was given a figure of 4,426,500. That is just the same as taking, that's the same as taking your 113,500 kgs times the actual price. How will you determine the actual price? To determine the actual price, you just be taking 4,426,500 divided by 113. Again, you multiply by 113. Instead of first going round, we'll just take our figure directly there. 4,426,500. So I'll just take our figure there directly. 4,526. That is 4,426,500. That should give us a variance of how much? That should give us a variance of how much, my two students? That should give us a variance of 111,000 kgs. We multiply by 40. We less 4,426,500 to give us a variance of 13,500. The question is it adverse or favorable? This is a favorable variance, because you'll find that whatever that we have here, in this case, I had budgeted to spend 4,440,000. I budgeted to spend 4,440,000, but we ended up spending 4,426,500. So it's as if I spent less than what I had budgeted. That's why you're terming it as what? As a favorable variance. So in that case, you are done with material cost variance. Go to number 2, type of variance that we need to calculate: labor cost variance. Labor cost variance. The question is, do you know how to compute our labor cost variance? Yes, we have that formula in computing our labor cost variance, and therefore, in this case, we should be talking of our standard hours times our standard rate. This should give us our total. This should give us a standard total labor cost minus our actual hours times our actual rate. My good students, that should give us what? Our total actual labor cost. Total actual labor cost. As the norm, we noted that standard hours will never be given. And how will you determine your standard hours? You determine your standard hours by taking your standard hours, okay, per unit times your actual units, times your actual units, times your actual units. That should give you your standard hours. The same case will apply. I'm going to ask myself this question: how many hours had we budgeted to use to produce 1 unit? How many hours had we budgeted to use to produce 1 unit? To produce 1 unit, according to our question here, we are told that direct labor, I had budgeted to use 1 hour to produce what? 1 unit of our material. So a 1 unit of 1 unit. So therefore, I should be talking of 1 hour here. Okay. 1 hour. We multiply by the actual units. Actual units is just the same here, 18,500. So therefore my SH, we should be talking of how many hours? 18,500 hours. 18,500 hours. So quickly we can determine our labor cost variance. We can determine our labor cost variance by taking what? By taking our that should be our standard hours, which is 18,500. We multiply by our actual rate. Our actual rate, my good students, I was given a figure of how much as our actual rate. I'll share this question. Actual rate, you can see I was given 70 shillings per hour. Not actual, but standard rate, I was given 70 shillings per hour. So 70 shillings per hour. So I should be having times 70. We less what? We less our total actual labor cost. The beauty with this question is that the examiner had given us that one directly. The examiner had given us that one directly. So in the figure that you're given here, we are given a figure of how much? We are given a figure of labor. Look at note 5. Direct labor, you are given a figure of 1,299,400. So you should be having here our figure 1,299,400. Very confidently, I can now determine our variance. Very confidently, I can now determine our variance by taking 18,500 standard hours times 70. We less 1,299,400. So that should give us 4,400. And this time around, I'm saying this is what? An adverse variance. That is our adverse variance, because I had budgeted to spend how much in relation to labor? I had budgeted to spend 1,295,000, but we ended up spending more than what we had anticipated. We ended up spending more than what you had anticipated. That's why you are saying it is an adverse variance. That's why you're saying it is an adverse variance. So we are done with that part in relation to material cost and labor cost variance. The other question is the other types of variances: variable, fixed, and what? And sales. So you can proceed and work it out. You can proceed and work it out. Remember, we've used this formula. So there's that other student who will prefer to use material, like in material. He can determine material price variance and material usage variance. Then he sum them up. We'll get the same answer. This other student in labor cost, he'll take or she will take labor rate variance, sum it up with labor efficiency variance. We are going to end up with the same answer. So in the event that the examiner hasn't specified where you need, or rather maybe he hasn't specified that you need to use, you need to determine material price, material usage, he has just mentioned to determine cost variance. The best solution that you can work it out also, which can also save your time, is this formula. Material cost variance to be SQ times SP and this other formula. Talk the same case with what? With the labor cost variance. That will be very easy and it will save a lot of your time. It will save a lot of your time. So after we've worked it out, I need us to compute what? Our variable overheads variance. Variable OHDs variances. And working out our variable overhead variances, we know very well that you normally talk of two main. That is variable overhead expenditure variance and variable overhead efficiency variance. So we start with variable overhead expenditure variance, which we know very well that to determine our variable overhead expenditure variance, we normally talk of what? The standard variable overhead absorption rate per hour times our actual hours, we less our actual variable OHDs. We know very well that is our formula, and we've been looking at this in our previous videos. We talked of this so much, so that at least you got the concept clearly. So looking at our variable overhead expenditure variance, working it out very quickly, my good students. We need to determine our variable, standard variable overhead absorption rate per hour in our question. In that case, I was given how much? Looking at our question here, our standard variable overhead absorption rate, I was given how much? Variable production overhead, I was given 30 shillings, right? So in that case, I'd be having 30 here times our actual hours. Actual hours given, you are given how many hours actual? Go to note 5. Note 5, direct material, I'm having direct labor. Direct labor, we are given how many hours? 17,800 hours. 17,800 hours. 17,800 hours. 17,800 hours. Minus what? Minus our actual variable overheads. The beauty part of it is that the examiner had given us that directly. And if you can see, I was given a figure of how much? I was given a figure of 588,000. So confidently, we can now determine our variable overhead expenditure variance. That should be a figure of how much? I'm going to take my 30, we multiply by 17,800 to give us 534,000, we less 588,000. My good student, I'm having a figure of how much? 54,000, and that is adverse. 54,000, and that is an adverse variance. 54,000 adverse variance. So that should be the variance that we'll be having. We should be having. Now, after we are done with that case, the other variance that I need to compute should be variable overhead efficiency variance. Which you know very well. I'll be looking at this by taking my standard variable overhead absorption rate per hour, right? Into our standard hours we less our actual hours. Standard hours we less our actual hours. That will give us what? That will give us 30, the standard variable overhead absorption rate per hour, into standard hours. Remember, we had already computed our standard hours here. Standard hours, we already computed it there. So you should be having 18,500 minus our actual hours. Actual hours, you can see very well, we had a figure of how much? 17,800 hours. So that should give us a variance of how much? I'll be having 30, yes, 18,500 minus 17,800. That should give us a figure of 21,000. And that should be a favorable variance. So, as simple as that, we have determined what? We have determined our variable over the efficiency variance. We proceed to our fixed overheads variances. We know very well that whenever we're talking of fixed overhead variances, again you have what? We have to fixed overhead volume variance and fixed overhead expenditure variance. So we start with our fixed overhead expenditure variance. This is fixed overhead expenditure variance. And you know very well how we are going to determine that. We'll be taking our budgeted fixed OHDs, okay, we less our actual fixed OHDs. As simple as that. we take our budgeted fixed overheads, we less our actual fixed overheads. We less our actual fixed overheads. So therefore, in that case, we should be taking our budgeted fixed overheads. And in our case, what are we giving us our budgeted fixed overheads? We look at our question here. Budgeted fixed overheads, you are given a figure of how much. Budgeted fixed overheads, my good students, you can see I was given a figure of how much. Go to note 2. Budgeted fixed production overheads per month is 1 million. What about your actual? Note 5. Fixed production overheads incurred is 1,040,000. So that should be as simple as that. We take our budgeted fixed overheads, which is 1 million. We less our actual fixed overheads, which is 1,040,000. I had budgeted to spend 1 million, but we ended up spending 1,040,000. So therefore, you'll find that I spent more than what I budgeted. So therefore, I should be having a variance of 40,000, which is adverse variance, So after we've done with that, my good students, we proceed and look at number 2, basic variance, fixed overhead volume variance. This is fixed overhead volume variance. And we know very well how to determine that if you've been watching our videos from the word go. In this case, we'll be talking of what? Our budgeted fixed overhead absorption rate. Remember, this time we are talking of what? Fixed overhead absorption rate per unit. You are talking of fixed overhead absorption rate per unit. Okay? Into what? Our budgeted output minus our actual output. Output in this case, ideally, we are talking of what we produce, what we have budgeted to produce, and what we are actually producing. So look at that case. What should be our budgeted fixed overhead absorption rate? Budgeted fixed overhead absorption rate per unit tutakuwa na how pesa ngapi? Come to our question here. Were we given that? And if you're not given, should we leave it like that? No. If you look at this question, I was not given anywhere budgeted fixed overhead absorption rate, but I was given budgeted fixed production overheads 1 million. The question is, do we know the number of units that we actually produced? Yes, we know the units that we produced. The units that we budgeted to produce, if you can go to note 3, we are told we had down how much? How many units? 20,000. So I need to determine how much of fixed overheads was I incurring per unit. How much of fixed overheads was I incurring per unit? That is what you are talking of it as what? Budgeted fixed overhead absorption rate per unit. So in this case, you'll find I'm going to have my total cost, which is 1 million. We divide by the number of units that you are budgeted to produce, which is 20,000. We saw that, which is 20,000, right? Into what? Budgeted output, we have the 20,000 minus actual output, the one that you are actually producing is 18,500. So therefore, how much will I be having as our variance? And if you can recall very well, we say that fixed overhead volume variance, this is a special cost variance. Mark it well. We said that fixed overhead volume variance, this is a special cost variance, meaning that it will behave opposite with the other cost variance. In other words, you are saying it will behave like revenue variances. It will behave like revenue variances because you are looking at our production. So fixed overhead absorption rate, I should be talking of how much? 1 million, right? 1 million. We divide by 20,000 to give us 50, right? To give us 50. So I'll be having the 50 into 20,000 minus 18,500. That should give me a figure of how much? 75,000. And this is adverse. Why are we terming it as an adverse variance? We are terming it as an adverse variance because I budgeted to produce 20,000, but we ended up producing how much? We ended up producing 18,500. We ended up producing 18,500. So after we've looked at that, my good student, the next component we'll be talking about is what? Sales variances. And we know very well, whenever we are talking of our sales variances, again, two concepts should ring at the back of our mind, basic. That is the sales price variance and sales volume variance So we start with our sales price variance. Do we know how to determine that? Yes, we know. We know very well that I'll be comparing what? Our standard selling price and our actual selling price for the actual quantity of units sold. So we are saying that at this point I'll be comparing our standard selling price per unit and our actual selling price per unit for the actual quantity of units sold. In this case, do we have that? Yes, we do have. Actual quantity of units sold in our question is so very well that we are given 18,500 units. What about our standard selling price per unit? I'd budgeted to sell these units with how much? Go to our question here. Looking at our question clearly, I'd budgeted to sell our products. If we go to note number 4, budgeted selling price per unit is for 40. What about your actual selling price? Note 5. Our actual selling price per unit is 480. So you are talking of for 40 minus 480. Already I'm seeing I'm having an adverse variance because I had planned to receive, I budgeted to receive 440 for every unit that I'm selling. But I ended up receiving 480. This is a favorable variance, right? This is a favorable variance. Look at that case. You had budgeted to receive 440 shillings per unit, but you ended up receiving 480, meaning that you're receiving more than what you had anticipated. And such, it is in favor of you. That's why you're terming it as what? As a favorable variance. A favorable variance of how much? A favorable variance of 40 minus 480 to give us a figure of 740,000. 740,000 favorable variance. Favorable variance of 740. After we've talked of that, another variance that we'll be talking about is sales volume variance. And we know very well that whenever I'll be talking of our volume variance, keyword being volume, I'll be looking at the difference between our budgeted sales units and our actual sales units. All these valued at what? Valued at the standard profit per unit. Understand it well. You are saying that all these are going to be valued at what? Standard profit per unit. So we are saying that our sales volume variance, that should be standard profit per unit into our budgeted quantity, budgeted units sold, budgeted units sales. That's what? Our actual units. Actual units that we sold. So therefore, in this case, the question would be, how will we determine our standard profit per unit? How will we determine our standard profit per unit? That will be very simple because you see the profit that you have written here, this was our budgeted profit, right? 1 million. We had determined that one earlier on. So I'll be having 1 million. We divide by what was our budgeted units. We had budgeted to sell 20,000 units, right? Into 20,000 minus 18,500. That should give us how much? I should be having, yes, 1 million divided by 20,000. That should give us 50, right? Into what? Into 20,000 units minus 18,500 units to give us a figure of 75,000 adverse. So in this case, my good students, we determine all our variances. And remember, our key agenda was to do what? To do the reconciliation. To do the reconciliation of the two profits, that is budgeted profit and the actual profit. And we are going to do this reconciliation using what? Using the variances that we have computed. And this is the next step. We are going to do our reconciliations. So allow me, we can erase here. We use this space to do our reconciliation. having in mind that we need to reconcile the two profits. We need to reconcile the two profits.